The U.S. stock market is currently in its pre-market session. As of Wednesday morning, January 14, 2026, Berkshire Hathaway Inc. Class B is trading at 494.62 USD, showing a slight pre-market decline of 0.62 or 0.13%. This follows the final bell on Tuesday, January 13, 2026, where the stock closed at 495.24 USD, marking an intraday loss of 3.43 or 0.69%. While most investors are looking at this minor pullback as just another quiet day for the Omaha giant, the actual reality is that we are currently witnessing the most significant leadership transition in corporate history. The market expects a slow, steady decline in relevance now that Warren Buffett has officially stepped down as CEO at the end of 2025. But the reality is that the new leadership under Greg Abel is currently sitting on a historic nearly $400 billion cash pile that is essentially a loaded weapon waiting for a market correction. The common belief right now is that without Buffett at the helm, the magic of Berkshire is gone. People assume that the company will become a bureaucratic shadow of its former self, eventually forced into paying a dividend it never wanted to offer. I am here to challenge that. When you look at the recent institutional activity and the way the stock found support at the 493 level yesterday, it's clear that the smart money isn't leaving, it's repositioning. While retail traders on the Robinhood app are busy chasing the latest volatility in Nvidia stock or Tesla stock, the reality is that Berkshire has just completed a massive cleaning of its equity portfolio, selling off nearly 75% of its Apple stock stake over the last year. This wasn't a lack of faith in the iPhone maker. It was a tactical retreat into cash at the highest interest rates we've seen in decades. Berkshire is now earning over $20 billion a year just on the interest from its Treasury bills. Over the last few sessions, the trading volume for BRK.B has remained surprisingly robust. Yesterday's 0.5% dip was met with significant buying pressure in the final hour of trading, preventing a break below the psychological 490 floor. This tells us that institutional buyers are viewing anything under $500 as a value buy. If you are using a professional platform like Interactive Brokers or managing an individual brokerage account, you will see that the stock is currently trading at roughly 1.5 times book value. The expectation was that the succession discount would drive the price down to 1.2 or 1.3 times book value once Buffett retired. The reality is that the market is actually placing a premium on Greg Abel's operational expertise, especially in the energy and rail sectors, which are seeing record capital expenditures in 2026. The market narrative for 2026 is centered on whether Berkshire can find a big elephant to buy. The expectation is that management is too conservative and will let the cash sit idle while the S&P 500 continues to march higher. The reality check is that Berkshire's cash pile is now large enough to buy 477 of the companies in the S&P 500 outright. While the retail crowd using their SoFi active investing account might be frustrated by the lack of action, the smart money knows that Abel is a much more aggressive operator than Buffett was in his final years. We are already seeing clues in the recent SEC filings that Berkshire is moving into Japanese trading houses and recession-resistant infrastructure at a pace we haven't seen since the 2008 crisis. This is a company that is currently designed to outperform in a high-interest rate, high-volatility environment. I want to hear from you because the post-Buffett era has officially started. Comment below how many shares of Berkshire Class B you currently hold and if you think Greg Abel should finally initiate a dividend this year. Do you think the $400 billion cash pile is a sign of genius or a sign that there are simply no good deals left in the market? I'm seeing a lot of debate on the Fidelity trading platform forums about whether Berkshire is still a must-own core holding, and I want to know where you stand on that. Let's look at what this company actually does, beyond just being a collection of stocks. Berkshire Hathaway is a diversified conglomerate that owns over 90 businesses. Their business model is built on float, the insurance premiums they collect from GEICO and Berkshire Reinsurance that they get to invest before paying out claims. This insurance segment is currently firing on all cylinders, with record underwriting profits reported in the final quarter of 2025. Then you have the BNSF Railway and Berkshire Hathaway Energy, which provide the boring but consistent cash flow that fuels the rest of the machine. The reality of 2026 is that these industrial assets are benefiting from the massive onshoring trend in American manufacturing. While people use their SoFi Invest app to track software startups, Berkshire is owning the physical tracks and the power lines those startups rely on. Past performance is staggering, with an average annual return of nearly 20% over the last 60 years. However, the reality of the last 5 years is that Berkshire has actually trailed the S&P 500 in several AI-driven bull runs. This has led to the expectation that Berkshire is an old economy relic. But look at the reality of the 2025 fiscal year results. Operating earnings were up 34%. The company is generating more cash from its operations than almost any other entity in the world. When the AI bubble or the tech-heavy rally eventually faces a valuation reset, Berkshire is the only company with the liquidity to act as the lender of last resort. This is why institutional ownership remains so high. Over 4,700 institutional holders, including Vanguard and BlackRock, have maintained or increased their positions this month. The future outlook for BRK.B in 2026 is tied to 3 major catalysts. First, the first annual letter to shareholders written by Greg Abel, expected in late February. This will be the manifesto for the next 20 years of the company. Second, the potential for a massive acquisition. With names like Occidental Petroleum already being consolidated, the market is betting on a major move in the utility or consumer staples space. Third, the resumption of share buybacks. Berkshire sat out of buybacks for much of late 2025 because Buffett believed the stock was too expensive. If the price drifts back toward the 450 support level, expect Abel to use $10 to $20 billion to retire shares, which would provide an immediate boost to earnings per share. The risk factors are centered on the key man risk transition and the massive size of the company. It is harder to beat the market when you are the market. The expectation is that Berkshire's growth will permanently slow down to match the GDP. The reality check is that their insurance operations, particularly GEICO, have seen a massive revival in 2025 due to better AI-driven underwriting. They are using the very technology that people say will disrupt them to actually increase their margins. While you might see some negative sentiment on various investing sites about the lack of innovation, the reality of the balance sheet, which shows $651 billion in equity, suggests that Berkshire is the ultimate fortress in an uncertain world. When you compare Berkshire Hathaway to other options like Fidelity ETFs or a standard Schwab Intelligent Portfolio, it's clear that this is the ultimate anti-fragile asset. It doesn't have the black box risk of a small cap like SMX or the regulatory targets currently on Alphabet stock. It is a company that thrives on chaos. Whether you are managing your own portfolio through a Fidelity brokerage account or using the Robinhood app for your long-term IRA, Berkshire is the weight that keeps a portfolio from drifting away in a storm. The current $494 pre-market price reflects a market that is unsure about the new leadership, but the fundamentals tell a story of a company that has never been in a better financial position. Looking at the technicals through your Fidelity mobile app or Interactive Brokers platform, you'll see the 200-day moving average is sitting down at 415. We are still well above the long-term trend line, which suggests the current pullback is healthy. The 52-week range of 441 to 542 shows that we are currently in a consolidation zone. If the stock can hold the 490 support through the end of the week, the path is open for a retest of the 540 highs once the Q4 earnings and the Abel letter hit the tape in February. To summarize the central insights of our analysis, the expectation for Berkshire Hathaway is a period of drifting as the world moves on from the Buffett era. The reality is a company with a $381 billion record cash pile, a revitalized insurance segment, and a new leadership team that is focused on operational efficiency and disciplined capital deployment. The contrast between the boring conglomerate narrative and the massive liquidity weapon reality is where the value lies for the 2026 investor. We have analyzed the intraday patterns, the institutional accumulation by Vanguard, the shift in the Apple stake, and the technical floor at 490. The outlook for the rest of 2026 is one of quiet strength, while the pre-market decline of 0.